Hello, it's Rhonda Thomas, and we're just about ready to do Chapter 5's Intro Problems for Financial Accounting. So let's go ahead and get moving. I will share my screen. And I have the problems opened up in Cengage, and I have my Excel sheet. And so Chapter 4 brings the accounting cycle to full circle. Okay, so let's go back up here. We still have the rules of debits and credits with their normal balances on the debit side or the credit side. But now we're going to start understanding what we've been doing through the last couple chapters. So here is the accounting cycle. All right, so once again, transactions are analyzed and recorded in the journal. Transactions are posted to the ledger, which we've done some of that. Then step 3 is your unadjusted trial balance. That was from chapter 3. Okay, then we want to gather the adjustment data so we can figure out what those will be so we don't miss any, make sure we have them correct. Then we have an optional end of period spreadsheet is prepared, and we're going to learn that. So it's not going to be optional for us. It is going to be part of how we learn this, because you learn a lot more when you use it. It involves pretty much Excel, and we'll be working with that. So then step 6, once you're finished with this end of period spreadsheet, then you make your adjusting entries. They're journalized and posted to the ledger in the same step. Then here comes the second trial balance, which is known as the adjusted trial balance. It's from the adjusted trial balance that financial statements are prepared. So we're going to create an income statement, a statement of stockholders' equity, and a balance sheet. I don't plan on doing any cash flow statements until we get to the chapter about it. Okay. Then once those are done, then step 9 actually is called the closing process. Okay. And I'm going to explain that here in just a minute. But the closing process. So there are entries for the closing process that we journalize and post to the ledger. And then after that closing process and posting them to the ledger, these 2 steps here, so we'll get our final trial balance. It's called the post-closing trial balance is prepared. Steps 9 and 10 really are preparing the accounts for the next period of time. So like the beginning of a year or the beginning of a month. It just depends on what the company normally does. Okay, so once again, this closing process involves basically 4 parts. Okay, 4 parts. I also included next to this here income statement, statement of stockholders' equity. This is the picture again of each of these 3, how this one has to be prepared, and then this one, and what numbers move down to the next one, and so forth. Okay, we're going to be putting together a little more sophisticated balance sheet. We're going to divide up assets, current and fixed. Current is assets we plan to use within a year, and property, plant, and equipment are your fixed assets. So we started going into that just a little bit for our adjustments, but no matter what, assets still have to equal current liabilities. So liabilities that we have to pay within the year. And then down here is common stock retained earnings. So this represents the ownership of the company and the rights to the assets. Okay, so if we get into something, we may look back at these. And then the final piece is the closing process. Okay, let me tell you what the closing process is. So here I've got a little explanation. Okay, so close doesn't mean that you're closing the account. It means to zero the account balance. Okay, zero the account balance. There are temporary accounts and permanent accounts. So your permanent accounts are all your balance sheet accounts. Your temporary accounts are your revenue, expenses, and dividends. Okay, permanent accounts, there they are. Permanent accounts are your balance sheet accounts, but your revenues and your expenses and your dividends, those are all temporary. It's the temporary ones that we close. Okay, and once again, closing means to bring their balance to zero, because we have to empty out all revenue accounts. We have to empty out all expense accounts. So they're open and ready and fresh for a new period of time. Okay, a new period of time. So here's how we do it. We journalize and post all revenues to retained earnings. So whatever is sitting in a revenue account with a credit balance, we will debit it to make it zero, and then we will credit the different that we will credit. Okay, so we're going to debit revenue and credit retained earnings, okay, for the revenue. And then all of our expenses are temporary, so they have a balance on the debit side. To zero them out, we credit it. Okay, so what we'll end up having is a certain amount of revenue and a certain amount of expenses that actually come out of these accounts and into retained earnings. Because we've always said that the result of your revenues minus your expenses is either net income or net loss, right? So a net income would be a credit to retained earnings when we empty out all the revenue, and the income, okay, or a loss, okay, either way, however it works. If you get a net income, it credits. If you get a net loss, it debits retained earnings. And then the final temporary account, if dividends are paid out, they're going to go into the account with a debit. So to close it, you credit it. When you credit this account, we debit retained earnings. So once again, all revenues, all expenses, and the dividend account get closed to zero, and then the offsetting credits or debits go into retained earnings. The difference in the above two entries to retained earnings is either net income or net loss, right? So we have to see what all of our revenues are, what all of our expenses are, and zero those out. And once again, the difference in the above two entries to retained earnings is either net income or net loss. And this is where they're doing that reconciliation. Revenues minus expenses, right? And then finally, journalize and post the dividend balance to retained earnings, zero balance in dividend account. All right, so when we get there, we'll walk it through. So this first one we're looking at is which ones flow into the statement. So you're still getting used to what is on a revenue, what is on an income statement, a statement of stockholders' equity, and a balance sheet. So remember, an income statement has revenues and expenses. Statement of stockholders' equity can have common stock, dividends, so can a balance sheet. Okay, so what we'll want to do is try to look over here at this to help us determine where these go. So cash. If you don't know cash is an asset by now on the balance sheet, I don't think you've been listening yet. But anyway, it officially is a payable. A payable. Okay, a payable is a liability. Yep, it's going to be on the balance sheet. Common stock. Now, common stock is on the balance sheet and it's on the statement of stockholders' equity. So let's see what it says here. Okay. The balances of the accounts that follow appear in the adjusted trial balance columns of the end of period spreadsheet. Indicate whether each account would flow into the income statement, the statement of stockholders' equity, or the balance sheet. Well, we haven't looked at the end of period spreadsheet yet, but it is going to flow into the balance sheet. Okay, hang on. They say statement of stockholders' equity, but I still say that common stock is reported. You can see it. It's right here. It's right here. But what they're trying to tell you is that we need to make common stock go through this account first before it gets to this one. And that's what we're trying to get at. Okay, so insurance expense. If it is truly an expense, it's on the income statement. Prepaid rent is an asset. It's on the balance sheet. Rent revenue is a revenue that can be that is reported on the income statement. Supplies is an asset, so it's a balance sheet. And dividends, I'm going to assume, is statement of stockholders' equity. All right, so in this question, if it is an equity, it goes on the statement of stockholders' equity, but I disagree that this also shows up in the balance sheet, but that's okay. They're talking about this end of period spreadsheet, which we'll get to here in a minute. Okay, so let me see what we have here. Okay, here we go. So then this next piece is the statement of stockholders' equity. So we will use our example to look at while we are trying to figure out what's going on. So up here is the statement of stockholders' equity right here. So what do we notice? We notice that it has two dates. Well, other than the top one, two dates down here, one beginning balance, one ending balance. So this is Naira Fuentes owns and operates anytime delivery services. On January 1st of 2007, common stock had a balance of. So let's go ahead and put in our dates in both places. Okay. Now they tell you right away what the balance is in common stock and retained earnings at the beginning of the year. Some problems aren't this straightforward. You have to look for it a little harder than that. So we're going to put 30,000 in here, and retained earnings has 829,000. And when we add across, okay, when we add across, we will have 859,000. Okay, 859,000. It says during the year, $16,000 of additional common stock was issued. So if you look here, issued common stock, it says an 11,000 of dividends were paid. And at the end of the year, anytime delivery reported the net income of 67,250. So let's put our issued common stock here. And we did an additional 16,000. So that just runs across with the totals. Then we have net income. Net income always causes retained earnings to go up. Okay. And then we want a 0 here. And then finally, dividends are usually the very last item if those go out. And it says use a negative number if a net loss is incurred or dividends were paid, enter the amount as a negative number using a minus sign. So that's not going there, but it is coming out of there. And our dividends are 11,000. Okay. Now we're going to add down. So we have 46,000 here. Okay. And then I'm going to add things up right here so that we can look and see what this stockholders' equity is. So I have 829, 67, 250, and 11,000. So let's add these three up. And it looks like it's 885,250. Now all we have to do is add 16 to this. So we're going to add 16,000 to it, and it is 901,250. Okay, so 901,250. All right, let's see if we're right. Oops, oops, oops. Okay, let me see what I missed. 8. Yep, I missed it here. 859. Okay, so 931. Sorry about that. 931, 250. So that's putting that together. So this is to help remind you. All right, now we're going to take care of a balance sheet. Oops. Oh, classified balance sheet. A classified balance sheet breaks up the assets into current and property, plant, and equipment, which is fixed. And I know they didn't even show this, but they can have one called investments. And then liabilities are current and long-term. Doesn't look like they have any long-term. So let's go ahead and figure out where these go. So accounts payable. So if you look at this balance sheet, under accounts payable, it's listed under current liabilities. Accounts receivable is listed under current assets. Accumulated depreciation for the building. Okay, well, accumulated depreciation is under property, plant, and equipment. Cash is as current of an asset as you can get. Common stock is stockholders' equity. Dividends are stockholders' equity. Note payable due in 5 years. Well, they don't have any long-term liabilities. So current is less than a year, long-term is more than a year. So let's see what they have here. Long-term liability. And then finally, a wage expense. Okay, a wage expense. Not reported on the balance sheet. Nope, that's on your income statement. So, of course, dividends in any other place, dividends are reported here on the statement of stockholders' equity, but it looks to me like it's the balance sheet here. Not reported on the balance sheet. There we go. Well, depends on when you're doing the balance sheet. If it's at the end of the year, then it gets closed. Okay, but if you're doing a balance sheet somewhere in the in between, you might see something in there, but this is supposed to be the year end, so I didn't read that very well. So there's 2 on here that are not reported on the balance sheet. Okay, so you don't see liabilities down here, but you do see them here in the statement of stockholders' equity. And it is an equity account. So, all right, let's keep going. All right, this is the closing process. All right, so we're going back to this closing process. So I'm going to show you how to get started on this. All right, so after the accounts have been adjusted on July 31st, so this is July 31st, okay, July 31st. Let me switch that so we can read it. Okay. This is the end of the fiscal year. So year end, July 31st. Very important to know what period of time you're looking at. Excuse me. Okay. I also have several accounts here, T accounts. So let's start with retained earnings. This is for the ledger, from the ledger of Haverty Services, Inc. So they have 648,210. Okay, they have dividends of, here we are, dividends of 45,000. We've got fees earned of 511,835. So you'll want to put these new balances in. We have wages expense, 348,500. We have a rent expense of 83,600. Supplies expense, 31,365, and miscellaneous has 10,455. Okay. So the first thing we're going to think about when we says journalize the two entries required to close the account. If an amount does not require an entry, leave it blank. Okay, so we are going to close all of the revenues. So how do you get rid of a credit of, so I'm going to go ahead and make these a certain color that we've put in their balances so that we know that that's what that means, okay? Because I know I've got my figures in here, but I am going to put the balances in blue. Okay, so all of this, all of these accounts need to be closed. Closing means to zero the account. It doesn't mean that you're never going to use the account again. Oop, that's the wrong side there. Sorry about that. Let me get that out of there. Okay, we want to go on this side. And then I'm going to change all the ones that we need to match what. Okay, so then all these expenses have their balances. Okay. There we have it. All right, so now let's think about it. Let's go to fees earned. How much is in fees earned? 511,835. Okay. There's one closing entry. We need to close this. So we're gonna show it right here. All right, then we need to close this one because that's a way. Okay, so this is a revenue, so it's going to be a debit. Here comes a credit. Okay, here comes a credit of exactly what we need it to be. See, notice I'm getting zeros here now, right? Zeros. Yep. And then 10,455. So let's see if we can do this. First one is going to be to debit fees earned. That's the only revenue account we have. But there it is. It's 511,835. What we're going to do then is close all the expenses with a credit. Okay, so the credit is 348,500. And we have rent expense with a credit of 83,600, and we have supplies expense with a credit balance of 31,365. It gets a credit in order to make that expense account have a zero balance. The last one is miscellaneous. Miscellaneous is 10,455. Now, we don't balance. Okay, we don't balance. So if you need to know, let's see how much we're off. So 511, 835. And then we're going to put in our wages. We're going to put in our rent, our supplies, and our miscellaneous. So now we're going to add down. And the difference is, right? So here's your revenues. And here's all of your expenses together, all of these. That's so you could do a total expense if you wanted. I just subtracted all the expenses. And then this is your net income, because that is the positive number that's left over, right? So this is going to be retained earnings for a credit. So we're going to credit retained earnings for 37,915. So here I am, retained earnings. I am 37,915. Okay, so let's see if we're right. Okay, so everything has zero. Zero is in revenue, zero expense, 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 expense. Now the last one is to zero dividends. So we're going to credit it and we'll debit retained earnings for the amount of the close. Okay, the amount of the close. So we're going to debit retained earnings for dividends, to close dividends, and then dividends gets that amount. The last thing I'm going to do, even though they didn't ask us to, is I want a new balance in retained earnings now. Okay, so we're going to add those together and subtract the dividends. So there's the new balance in retained earnings, right? Looks like we paid out more in dividends than we brought in income. Whoa, right? So that is income, but this is dividends. And we sent out more dividends than we brought in income. You say, is that wrong? Well, you probably wouldn't want to do that too often. Look what happened to retained earnings. So now we have less. Okay, now we have less. Okay, so, all right, let's go through the rest of this now. Here's the accounting cycle, wanting you to put together the 10 steps. My advice to you is this. My advice to you is know that the first unadjusted trial balance is step 3. Okay, unadjusted trial balance. Step 7 is the adjusted trial balance, and step 10 is the last trial balance. Okay, post-closing trial balance. So knowing where those are helps a lot. Okay, so the first thing we're going to do is transactions are analyzed and recorded in the journal. Then they're posted to the ledger, and then we do a trial balance. It's the unadjusted that's first. Okay, and then after the unadjusted trial balance, we're going to gather adjusting entry information. Let me see here. And what you do is you can go up here and look, right? So you can go up here and look. So number 4, they say is adjustment data are assembled and analyzed. Adjustment data. Do I go all the way down there? Post-closing trial balance, no. Are journalized and posted to, there it is. There's the data. It's assembled and analyzed. Then you make the entries for adjustments. Adjusting entries are journalized and posted to the ledger. Okay, and then we do the optional end of period spreadsheet. Hold on just a second. So what is number 6? Number 6, oh, sorry, that's this one. So I forgot about the optional spreadsheet, which we are going to do. Okay, we'll do that in more than likely quite a bit more in the coursework. Okay, so let me get this one. And then let me fix this one. So this one is the optional, there it is, optional end of period spreadsheet. Then, okay, then we do the adjusted trial balance, then we prepare the financial statement, and then we do the closing process. There we have it. Okay, it is good to understand these. Okay, last one. Okay, this one has what's called working, these are called ratios. Okay, ratios. All right, and this is, everybody's going to have a different number for this one. Let me scoot this over. Okay, so working capital. So what we've got, current assets and current liabilities for Abe's insulation services are as follows. So we have the most current year here and the year before here. This information has been collected in the Microsoft Excel online file. Open the spreadsheet, perform the required analysis, and input your answers in the questions below. So we're going to be finding what's called working capital. Here is the formula. Working capital is current assets minus current liabilities, and then current ratio is current assets divided by current liabilities. So let's go ahead and open the spreadsheet. And we'll do this inside here first. Okay, so you have to be careful. You can't just put a number in. You've got to put a formula. So equals current assets. Make sure you're using the right year. Current assets minus current liabilities. Enter. Okay, and then current assets divided by current liabilities. Okay, and let's make sure we do this for the previous year. Equals current assets minus current liabilities of last year, and then current assets divided by current liabilities. All right, so what does this mean? What this means is working capital has gone up from last year. That is a favorable trend. So notice current liabilities are going up, but it looks to me like we're growing with more assets. We did increase our liabilities, but we're growing. And then the current ratio, what that means is for every dollar of liabilities, there is $2.10 of assets, right? For the year before, every dollar of liabilities, there was $2.05 of assets. Well, these are both going in favorable trends. Okay, so now we're going to hang on to this. So let me put these in here just a minute. Okay. Okay, let me get this right. 449. So that's the current assets. Here comes the current liabilities. There's the working capital, and there's the current ratio. Last year's current assets. Last year's current liabilities. Okay, so now we're ready to put this in. So we close Excel. Now we're ready. Okay, it looks like we've got 759,000. Current ratio is 2.10. Okay, and then last year's working capital, 561,750 and 2.05. So does the change in the current ratio indicate favorable or unfavorable? It's favorable. Yep, because the more you can have here, the more assets you have compared to your liabilities. So there you have it. Okay, that is chapter 4's intro exercises. Stay tuned for, all right, so let me get that saved, and then I'll do another video for the coursework. Okay, I am closing out and stopping my share and saying goodbye. Thanks for watching the video, and we will keep moving forward.